put through two rating changes yesterday. The first one was Aurizon, so we've upgraded that from a hold to an add. Just as a reminder, Aurizon, if you look at it, about half of the earnings come from the below-rail track network in central Queensland that services the coal mines exporting coal out of central Queensland. You might remember that those revenues are regulated by the Queensland Competition Authority, exactly the same sort of regulation as like a regulated utility, gas pipelines or electricity, etc. Look, with the customer agreement that was finalised late last year, actually, the revenues from that side of the business are pretty much locked in until FY27. So the focus of that side of the business is going to be cost out for the next couple of years at least. And then the remainder of Aurizon's earnings come from above rail haulage, of which the vast bulk is focused on the coal haulage side of things. They are subject to long-term, almost take-or-pay style contracts, just basically a lot of the revenues coming from provision of capacity. So what am I thinking in terms of the recommendation on this one? Well, the stock has fallen off its highs by about 14%, so it hit a high in September over $6. Yesterday it closed at $5.27. I've lifted my target price 16 cents, it's now at $5.78, so a bit of that comes from remodelling on the tax side, a bit of that comes from a roll forward evaluation. So your potential upside there is about 10%. If I look at the valuation multiples that pop out the bottom of my DCF valuations, they're not stretched, so I think that's a quite comfortable target. For those of you that have got income-orientated clients, this isn't a bad one to have a look at. So it pays out 100% of its earnings as a dividend, and that's implying around about a 5% cash yield at the moment, sort of 5.3-ish or so. And it has been paying out around about sort of 70% of its dividends as a franking with the dividends. So I think it'll be attractive to income-orientated investors. Obviously, it's not a locked-in certain sort of rising dividend because, you know, of the fact that the dividend payout is based on the earnings. But I think it's a fairly sort of stable number sitting around where it's going to be over the next couple of years. Look, I need to highlight Aurizon. Is about 2/3 of the way through a $300 million on-market share buyback. That share buyback will pause effectively from the 1st of January through to when they publish their result on the 10th of February. So there is the potential that the share price could wane a little bit in this time. So there could be you might have a window here of actually being able to buy it a bit cheaper. But just on a pure one-year investment horizon, I think there's value here at the current share price. Now, is this where the buyback finishes at the end of $300 million? To my way of thinking, no way in the world. In August last year, they announced that they have restructured their debt profile. So previously, they had debt against their network business and not very much against the rest of the business. They announced that what they have done is actually put new debt against their above rail business separate to the debt they've got against their network business. Balance sheet still remains very high credit quality, so it's BBB plus or equivalent credit ratings. So for you out there that are looking at this sort of stuff, that's equivalent to like a Sydney Airport or Transurban's credit rating. So still a very strong credit profile. What could they do with that capital at $1.2 billion? Well, the CEO has been at pains, have basically been saying, we don't have many growth options. We really don't. So I think it's fair to say that $1.2 billion is going to get ploughed into further buybacks. Gosh, at the $300 million that they did over, let's call it 6 months, we're looking at probably another 2 years of share buyback in the market. The current buyback has been absorbing around about 5% of the buying while it's been on. So you've got a sort of technical support there for the stock once that actually comes online. So what's the next bit of news flow? I suppose it's the first half result in February. I don't think there's going to be any disaster sitting in that. I'm expecting about 8% EBIT growth and around about 16% dividend growth. So quite comfortable putting an add rating on the stock at the moment. Cleanaway, look, I've downgraded that from an add to a hold. The downgrade is purely on compression and total return potential. So just a reminder with Cleanaway, around about sort of 70% of its earnings comes from its very high quality solids business. That delivers margins of sort of 26% EBITDA margins, and they expect that they should be able to push those up into the high 20s over time. The other part of the business to me is a lot lower quality, or particularly elements of it are a lot lower quality, and the EBITDA margins on those are more in the teens sort of range. So look, with you might recall the October AGM, they put out an earnings update, an outlook update, and the market really smashed it at that point in time. Share price has certainly recovered since that time. It's trading at, yesterday, $2.01 at close. My revised target is $2.03, so there's really not much upside there. and it's yielding, well, it's always had a fairly low dividend yield, so it's yielding around about 2%, 100% fully franked. So look at what I've done there, pulled that rating back from add to hold. Forecast downgrades are very minor. You might remember that one of their facilities over in Western Australia caught fire late last year and was pretty much totally destroyed. So I've put through some very minor downgrades on that front. Valuation roll forward has meant that there is a minor increase in the target price to $2.03. Next news flow will be that first half result on the 19th of February. We've already got the AGM guidance, which is saying, look, we expect only sort of flattish earnings in the first half with growth to come through in the second. So look, what I'll be looking for there is A, just how sensitive these earnings are to the economic environment, and B, just how much exposure they've got to recycled commodity prices, and C, what the outlook is looking for the second half and beyond. So look, just want to highlight, I'm still very much, I like the thematic for this story. The recycling and the waste management side of things. I think the management is very good. I like the cash flow growth that's coming through. I like what should be balance sheet deleveraging on a steady state basis. So the downgrade is very much just on just that compression, that total return potential.